Most people spend decades doing everything right, saving into their 401ks, being disciplined, building a nest egg. And then they retire and the IRS shows up with a bill they never saw coming. It's called the required minimum distribution. And if you're not planning for it, it can quietly push you into a higher tax bracket, increase your Medicare premiums, and trigger taxes on your Social Security all at the same time. Today, I'm going to show you exactly how that happens and what you can do about it before it's too late. First, the basics. When you save money into a traditional 401k or IRA, you get a tax break on the way in. You don't pay taxes on that money until you take it out. The IRS has been patient, but they won't wait forever. Once you turn 73, they require you to start taking money out every year, whether you need it or not. That's the required minimum distribution. The amount is calculated based on your account balance and your life expectancy, and it gets larger every year. So if you got $1 million in your IRA at age 73, you might be required to take roughly $37,000 out that year. At 80, that number could be $65,000 or more, even if you don't need the income. Here's where it gets painful. The RMD gets added to what other income you have, Social Security, a pension, part-time work, anything. And suddenly your total income is higher than you planned for, high enough in some cases to push you into the next tax bracket. But it doesn't stop there. Once your income crosses certain thresholds, two other things happen that most people never see coming. First, your Social Security benefits start getting taxed. Up to 85% of your Social Security can be taxable income. Second, your Medicare Part B premiums go up. It's called IRMAA. The more income you show on your tax return, the more you pay for Medicare. We're talking hundreds of extra dollars per month. Higher tax bracket, taxable Social Security, higher Medicare premiums. All from that money you save responsible for decades. That's the trap. The good news is that one of the most plannable problems in retirement is that, but only if you start early enough. Here's 3 different strategies worth knowing about. Number 1, Roth conversions. In the years between age 73, or when you retire and age 73, you may be in a lower tax bracket than you've been your entire working life. That window is an opportunity. Convert some of your money into traditional money in a IRA to Roth and pay a lower rate. It will reduce your RMDs later. Smaller balance, smaller RMD, smaller tax bill. Number 2, Qualified Charitable Distributions. If you're charitably inclined and over 70 and a half, you can send all the money from your IRA, $105,000 per year, directly to charity, and it reduces that RMD. It's one of the cleanest tax moves in the tax code, and most people have never heard about it. Number 3, know your threshold. Sometimes the goal isn't eliminating the RMD, it's managing how much income you show in that given year, which reduces Medicare costs and Social Security. That's where coordinated plan, the real differences versus reacting year to year. RMDs are not something you can fix after the fact. Once you're 73 and the distributions start, your options narrow significantly. The planning happens before that, ideally 5 to 10 years before. If you're in your late 50s or 60s, and this is the first time you're hearing about any of this, this is exactly why I make these videos. If you want to talk through your specific situation, there's a link below to grab 30 minutes with me directly. No cost, no pressure, just a conversation. I'll see you in the next one.